how would you be allocating your assets based on potentially a rise in inflation?
Okay. Well, what's interesting is we're just off of our quarterly strategy summit where we re-underwrite all of our core views that we're going to express in portfolios. And clearly coming out of February, a lot of discussion about, changing views on inflation and the pickup in volatility. I think some of our views are a bit more nuanced with respect to equity markets where we're putting some emphasis. But with respect to inflation, I think our views are that inflation is likely to trend higher with overall growth in the economy, but basically moving back to about the 2% level. That being said, there is perception of more two-way risk in the market, where you're likely to see markets overreact one way or another to different inflation prints. Again, what we saw in February and what we saw last week in both positive and negative. But we see rates maybe drifting a little bit higher here, maybe something north of 310, 315, but nothing that we would dramatically make a big bet on duration.
So 310, 315, are you the Jeff Gunlock school that's going to be a weaker dollar, bad for equities, the whole shebang, or do you think that the markets can handle that? And how do you allocate to that?
Yeah, again, we think equities still do okay in that environment. What's going to drive equities, particularly in the U.S., will be earnings. So we think you're going to see solid earnings in the U.S. this year. And that, while rates might go up modestly, it's not going to be enough to derail, a continued rally in the U.S. The big difference for us is where we came into the year with a view that you'd see a big upgrade in terms of earnings and earnings revisions. That has somewhat moderated. So you're not going to see the big earnings surprise. And that's really what's led to a bit more of a nuanced view for us, particularly outside the U.S. Whereas we came in, not only we wanted to be long stocks in the U.S., thinking there would be an uptick, an upgrade to earnings, but really you wanted to play that in a globally diversified way. And really what's been a bit more nuanced is our relative view on EM, emerging market equities, versus Europe and Japan. And I'd say on EM, I think to the extent that we're still in the camp that you're going to see above trend growth, and that global growth will continue to basically move above trend rates that we've seen. Yeah. The most levered play there is EM. So I think that becomes our most favored market outside the U.S.